This episode is sponsored by Midlock Investment Partners, the real estate investment firm, operator, and fund manager. Midlock invests in middle market properties valued between $5 and $50 million in the Midwest and beyond, using a value add strategy. Learn more about Midlock and join their mailing list at midlock.com. That's Midlock, MIDLOCH.com. Thanks, Midlock, for being a sponsor of Passive Investing from Left Field.
Investments are complex, and dumbing them down to like meeting or not meeting a single variable is a big mistake.
Hello, Left Fielders. Welcome to the Passive Investing from Left Field podcast. Our community is focused on networking and education to help people invest passively and think differently. Let's go.
Hi, this is Tom Wheelwright, and you're listening to Passive Investing from Left Field podcast.
This is Chad Ackerman, and you are listening to the Passive Investing from Left Field podcast. Today, our guest is Aleksey, and he gave me permission not to bring up the last name. I'm going to go ahead and throw myself under the bus, but we really appreciate you coming on. Aleksey advises limited partners on existing and future investments. He writes weekly articles to 3,500 investors at lplessons.substack.com to explain how to properly vet and think about LP investments in the grand scheme of their portfolios. Prior to advising LPs, he also ran Store Capital's $10 billion commercial real estate portfolio and oversaw the firm's underwriting team. Aleksey, welcome to Passive Investing from Left Field podcast. We appreciate you coming on.
Thanks, Chad. Such a pleasure. Great pronunciation of the last name, too.
Again, I throw myself under the bus.
No pronunciation is better than a messed up one.
Exactly. That's out of total respect for you is what that is. So really appreciate you coming on. We always like to start these out and hear the journey that people have gone through to get to where they are today. Could you tell us a little bit about your history and what got you here today?
Yeah. Look, just at high level, was born in Russia, came to the U.S. when I was 11. That was in Arizona, Tucson specifically. Went to school there, went to college there, got 4 majors instead of sort of focusing on internships and work experience. Then kind of like had several different experiences on the buy side, including algorithmic trading, distressed debt. Eventually found my way to real estate at the experience that you just mentioned, which was Store Capital. There I led a 20-person team, which at any point in any given week looked at, somewhere between 10 to 20 deals, many of which we didn't do, some of which we did. We'll take it to investment committee, buy it, transacted on well over $1 billion a year from anything that we liked. And yeah, it was a phenomenal experience in terms of understanding different incentives, right, between the different partners in a deal, understanding risk a little bit more, and just, I don't know, it's just pretty amazing when you see that level of volume. And then, I guess to be candid, kind of stumbled upon this idea, where I saw that there was a pretty incredible dollar amount of commitments coming from LPs into syndications. I think all of those commitments come for all the right reasons. Like, I think there's a lot to be gained in syndications, but I also think that a lot of the commitments are coming from people that don't necessarily come from an investing background, right? And I think most people would agree or acknowledge that. And so I didn't see anyone operating in the space. After a few Google searches, and I was like, well, I think I can help. And so I launched, and here we are.
That's great. What year did you launch? When did you roll this out?
I rolled this out 6 months ago.
Oh, nice. Gotcha.
Yeah.
The year was 23. I got it. No, it's funny. That's a lot of, it's a lot of what the left field investor story is as well, that we saw a gap in knowledge to teach people how to be limited partners. And that seems like the flag that you're carrying as well, which we think is awesome. So we totally respect what you're doing, because it's a lot of what we've been trying to do as well. So That's great. So you do a lot of coaching. You talk to LPs. You try to coach them, help them understand what's going on. We're an LP community. I'll give you an easy one to start out with. But when you're doing your coaching, what are kind of the three things that you want them to walk away with when you're done to help them understand how to get started in this space? What are some items that you hit on that you want to be sure are fundamentals that they need to worry about?
So I guess I'm still warming up to different names. I'm not sure coaching would be the right phrase. And that's because coaching sort of assumes that the person is interested in gymnastics or going to the gym or whatever. And it assumes that that strategy is best for them. And so I think that segues pretty well into your question, which is like, what do I typically tell them? I think the first thing is, and I'm pretty open about this, like, should you be doing this? Period. Like, and I think the answer I'm pretty public about this as well. Like, I think a lot of people who got into syndications over the past few years shouldn't have. And that is not a comment on deals going bad or the state of the market. I just don't think it was a wise idea. And at the same time, I think many people that should be in syndications are not. And so I think my goal more than anything is have an independent opinion. Like, I don't get paid by the GPs. And I guess I feel pretty comfortable telling people what I think without people not liking it. So that's sort of what I pride myself in.
Yeah, no, well, sometimes, especially when it comes to finances, we need blunt responses. There isn't a gray area, or there shouldn't be a gray area, but there are a lot of gray areas. So no,
For
that's
sure there are.
Respected.
And by the way, I think a lot of people, I get calls, I don't know, probably once a week that go something along the lines of, hey, I sold a business, 20 million liquid. Can you tell me where to put it? And my answer is absolutely not. And first of all, I just don't do that, right? Like, I don't do capital introductions. But more importantly, I just don't believe in blindly placing people into stuff without them understanding what they're getting into. And I don't mean like you sign a 30-page agreement that says you might lose all your money in 10 times over and over again, and you still signed it. I mean, like, really internalizing what you're getting into and like understanding the probability of the loss and what catalysts would come out of it. As of right now, at least, I don't have much of an interest to advise people that don't have the time to be advised. You know what I'm saying?
Yeah. Yeah. Well, time is money for you as well. So I get that. Yeah. We hear a lot of that at Left Field as well, that they want financial advisors, which is not what we are. We're here to educate, and it's a very active role for anybody to be in. They need to play their part usually as well, or we encourage them. They need to play their part. So we totally get what you're talking about there for sure.
I really believe this to be the case. I think the best passive investments always start in a very active manner. And anyone who sort of discounts that, I think to be candid, I think they're just gambling. And when you gamble, sometimes everything works out and you might 2x or 3x. And sometimes you lose all your money. The difference, I think, is, when you go to a casino, you realize that you're gambling, and therefore you sort of, you limit the amount that you put on the table, right? When you don't feel like you're gambling, but instead you feel like you're actually investing, I think people don't do that anymore, and I think that's where people get caught, unfortunately.
Yeah, I agree. That's when you find yourself in trouble. It seems like I would agree from situations that we've seen as well. That's great. So on your website, you have an article that's out there available for people to check out that's called Top 15 Syndication Mistakes. And this is great. I read through these. These are very good. I wanted to talk to you about this first one that you listed, because this is a topic we see in our forum a lot. In the article, you talk about that you recommend that nobody should get into deals with LP splits that are less than 65%. And generally, I think most of us agree with that. The question I wanted to bring up to you, because we've seen it discussed with our forum, is that occasionally we'll get into deals that have perpetual holds, that the operator isn't looking to sell in 5 years or 7 years or whatever. He's going to hold it for 20 years and it's going to cash flow. He'll refi money out and cash flow the rest of the time. Does that kind of structure make you feel any different? Because it seems like those structures tend to have a lot weaker splits for the G or for the LP. And I'm just curious, because this is what gets discussed a lot with our group, of whether that's a pro or a con to have that perpetual hold alleviate some of that lower split in the capital gain at the end of it. What are your thoughts around that?
Yeah. So I think I'll start with a disclaimer, and then I'll try to answer your question in two different ways. The disclaimer is the top 15 syndication mistakes, and there's like that disclaimer is in there, but in the event that people don't read it, since they're listening to this, I think it's important to understand that those are not meant to be red flags, right? What I called them specifically, and again, there's like a whole paragraph on this, is I called them reasons to stop and think. In other words, just because you see a deal that is, let's say, a 50-50 split, I'm just going to, be a little bit more extreme, not 65 even, but it's 50-50. I think the wrong thing to do is be like, oh, I remember Aleksey said 65% or bust. And I would say that is not what I said. What I said is if it's less than 65%, you should pause for a minute and see if there are other aspects of this deal that sort of compensate for that. And I'll just give you an example. Let's say you said 50-50 and you almost passed, but the next guy didn't pass because he went to the next slide and he realized that the pref was 12%. Or he went to the following slide and he realized that there was a 50% co-invest. And usually it's, let's say, 5 to 10%. And so like my whole point is, investments are complex, and dumbing them down to like meeting or not meeting a single variable is a big mistake. And it sort of, it gets us back to the whole gambling conversation. By the way, and for what it's worth, the same thing applies to IRR. I talk about this publicly all the time. Like, it's a massive mistake to filter deals based in IRR, for the same exact reason. Now, to actually address your question, so I don't. I think one of the things that's kind of missing in your question is, are we looking at the same type of investment? Right? In other words, you have deal one that is a value add deal, and I'm just going to make things up, right? And you can tell me if that's not what you meant. So it's like it's a value add syndication, deal by deal, so it's a single asset. And here we have, I don't know, like 8% pref, 80-20 split, right? And that one has like a 5-year hold, let's say, or that's at least the goal, right? And then the next one is, let's just, for extreme sake, let's say it's the same exact asset, and the GP is now saying it's a forever hold, right? But I want 70% of the profits, meaning it is going to be a 70-30 split the other way, 70 going to GP. And I guess the question that I would pose back is, under those circumstances, why would you ever pick B, right? Because in A, first of all, and I think this is like many times deeply misunderstood, as an LP, you're signing up for risk today, and you have little to no say of what happens thereafter, right? So just because something can be stabilized or can sell at a certain cap rate or whatever, like none of that is really up to you anymore as soon as you wire the check. And the reality is that you need to be compensated for taking on the risk and funding the majority of the capital. That's important. We're typically talking like 90 to 95% of the equity stack coming from LPs. And and in that circumstance, like, are you making a debt-like investment or an equity-like investment, right? If you're making an equity-like investment, you better participate in the upside. And if you have those two sort of scenarios that I laid out, maybe I'm wrong, but I can tell you that personally, I would choose A over B 100% of the time. It's the same exact asset, the same exact strategy. In 5 years, I get 70% or 80% of the upside in terms of the promote, and there's a pref. In the other one, like, I mean, who cares that? I mean, the hold is sort of irrelevant here in a sense, because if you think about the cash flows, like, it's the same exact asset, so to speak, right? So like year one, the cash flows are the same. Year two, the cash flows are the same. Year three, the cash flows are the same. 4, they're the same. The difference is in year 5. Do I sell or do I not sell? If I'm in situation A, then I just sold the asset and I got 70% of the upside, and I can reinvest that cash into something else. So, under what circumstances would I ever accept 30% of the upside when I think I should be having, 70 or, 65 is sort of where I guide it to be safe. And again, there's like other variables that matter, right, in this whole equation. But my point is the length of the hold, at least to the extent that we're discussing it now, should carry, in my opinion, very little weight.
No, I think that's a fair point. I think it's the cash flow hunters that like the perpetual hold. So maybe there's it boils down to individual's goal, which to your point is one of many variables that comes into this discussion. So on the table with looking at it from just the vacuum of just the scenario of perpetual hold versus not, I agree with you. The time value money tells me I'd much rather have my money back in 5 years plus some gain that I can go reinvest and make more money on that rather than a trickle over a period of time. But it's an interesting discussion that goes on that I get swayed either way, but I like your argument today.
Yeah. And I would just to add, I don't think it's about cash flow, meaning you can like cash flow, right? But the question is like, I mean, if you just put those two things into a model and understand it with math, again, I would be shocked if you could convince me that B makes sense logically. And that's because, again, like year 0 through 5, so to speak, the cash flow is exactly the same. In year 5, you have an exit and you make a massive promote. That cash can now be redeployed again and you'll make cash again. So meaning anyone who says I'm investing in this because I want cash flow forever, you will get cash flow forever. It's not like the cash in year 5 comes to you and sits under a pillow. You can buy whatever you want with it. You can invest it into another syndication. You can buy, whatever you want. You can certainly buy another cash flowing instrument with it, right? So I guess that, that's what comes to mind. I think.
Yeah, no, I think that's fair.
Rust Belt Capital is an elite Ohio-based private equity firm with a specialization in long-term, high cash flow multifamily investments. If you're looking for long-term recurring income, you should check out Rust Belt Capital. From their approach to managing risk, to the locations they invest, the product quality they provide, this firm is serious about what they do, which is why the owners of Rust Belt Capital invest their money in every deal they take on. Review their case studies by visiting rustbeltcapital.com. That's rustbeltcapital.com. Once again, rustbeltcapital.com, or email investor@rustbeltcapital.com.
Visor provides investors with a secure platform that displays a comprehensive view of all of their holdings on a single, holistic dashboard. From real estate syndications to private equity, crypto to traditional investments, with AI-driven, unbiased, honest insights to maximize return, Visor is your one place to rule them all. Automating performance tracking, projecting future cash flow, analyzing all your financial documents, and much more in one powerful solution, making it easy to follow the money. Sign up for a free 30-day trial now at Visor.co.
One of the other topics I've mentioned to you before we jumped on the call that we get a lot of discussion on is understanding the difference and the impacts of return on capital structures versus return of capital structures that GPs set up differently. And, you know, we assume that they understand the difference themselves, but maybe sometimes they don't necessarily either. But can you kind of help educate the listeners about what the difference of on versus of, that one little letter difference, how big of an impact that can have? And is there one versus the other that you think the LPs should be looking for in the deals that they do get into? Shame on me, for the first two or three, I didn't really pay attention to it. And then it became a topic of discussion. I went back to look because it does have a decent impact to how you're performing in your deals, that I pay attention to it more. But could you walk us through kind of the difference between the on and of and your thoughts around that topic?
Sure. So I think maybe first I'll define them. And you can tell me if you disagree in terms of how you guys kind of look at them in your group. Typically, return on capital is sort of like the return that you're getting. You invested $100, and let's say there's $10 to pay at the end of the year, let's say. So the question becomes, is the $10 that's coming to you a return on capital, which would be sort of you made 10% on your $100 investment, right? That would be one case. Or is the $10 coming in to decrease your basis from $100 to 90, which would be return of capital? The latter, meaning return of capital, is a topic that I wrote a specific article about called "Don't Budge on Return of Capital." Sorry. And I have like very strong feelings about this. So I guess let's just start with the basics. A very standard waterfall is the pref comes first. The second thing is return of capital. So in other words, you return all the capital that was invested to all the equity investors. C or 3 is the promote that starts kicking in. Okay. The reason why the second step is important is because I don't like using extremes like never, but I genuinely think that this is a statement that should apply in 99% of cases. There should almost never be the case when a GP is sitting inside of their promote, meaning step 3, before you've made your money back. And the reason why that's important is if you skip that step, what ends up happening is if the deal goes sideways, the GP could be collecting part of their promote, and you haven't made your money back. Like that is a very off-balance alignment of interests that I guess, in my personal opinion, an LP should not sign up for. Right? Like if you're putting up 90 to 95%, in some cases 100% of the capital, why would you ever allow the GP? I'm not talking about fees. Like fees are a part of the structure anyway. Like they're collecting fees, and that's normal. They need to sort of they need to pay their operations, right? But why would you ever allow the GP to sit inside of their promote before you get your money back? So that's how I would kind of describe it. And I mean, again, I just can't say this any stronger. I think like I would be very vigilant about this topic. I have seen it, I guess to put it like in a politically correct fashion, like I've seen it skipped multiple times when it came to docs. and it was missed by attorneys and by the LP, and it's a very painful thing. Look, if things like you knock it out of the park, like you just get less economics, which you should be getting. But if you don't do well, that ends up hurting a lot.
No, that's fair. It luckily, yeah, I haven't been burned on it, but I do have some deals that when I went back and looked at the language, it was a return of capital scenario that luckily they sold out, and I got things back at a decent price that I was happy with the returns on, that didn't totally hurt like you're talking about. But yep. Something so small that I think it is skipped over by the LPs a lot, especially that just, we like to call it out and make sure people are paying attention to it just to be sure.
Yes, exactly.
Yeah, so the other thing that I wanted to bring up, and I've heard you talk about this on other podcasts that you've been on, kind of discussion in around the current state, the current economy, the current state of this investment world that we're in. We're seeing a lot of situations where we're getting capital calls or even foreclosures that happen to investments that we're in. As you mentioned earlier, there's not a lot we can do once we're in the deal. But can you talk about maybe advice you give in your articles or whatever about just setting expectations ahead of time for LPs under the current state versus 4 or 5 years ago? Everybody was jumping in. Everything was very rosy. There wasn't a lot of concern over these kind of things. It's kind of reset under the current economy that there should be lower expectations of big returns, big IRRs, like you were saying earlier, but also like we should be aware of what capital calls are, what are our rights when we get to those situations if they occur. Just that general expectation reset for the LP over what it was maybe 4 or 5 years ago. Can you talk to kind of how you've written about these items too, and maybe advice that you're giving to focus on?
Sure. So I guess first, my advice wouldn't change, irregardless of what macroeconomics are in place. What changes is investor sentiment and emotions, right? And so those are very separate, in my opinion, from what is sort of like a healthy investment principles, right? And so I just wanted to separate the two because I think they're very different. In terms of what I would tell them, to your point, like once you're in a deal, there's generally not much you can do. The value of information though is real, and I'll just give you a few examples. I think some LPs tend to take the approach of, well, I'm already in here, so like it is what it is. Whatever happens, happens. And I think, to be fair, I do think that's true to some degree. If the dollar amount is material to you, A, or B, you are, let's say, in the top 10% of knowledgeable people in the LP stack in terms of like real estate syndications and real estate and capital structures and things like that, then I would really tell you that I don't think you should just stop there, personally. And the reason why I say that is a healthy GP should keep themselves accountable, right? What tends to happen when GP interests and LP interests start to diverge in distress situations is they need someone else to keep them accountable, right? And I'm not here to sort of say that it should be the LPs. Many GPs can do it by themselves, and they do a great job at it. But I can certainly tell you from personal experience of advising a bunch of LPs, there are many circumstances where they need. They might not want, right, which is different than need, but they do need some of that external questioning and pressure. Because look, like, and I don't mean like lawsuits. I don't mean, aggressive language. I just mean like someone in the LP stack needs to dig in and understand what's going on and make sure that the decisions that are being made actually make sense, right? And I've seen many circumstances where it doesn't. To give you a very practical example of this, let's assume that you're a GP and I'm an LP, right? So I just invested $1 million with you, and let's just say I'm your only LP. So I invested $1 million. You bought a property, let's say no debt, $1 million. Fast forward 5 years, the property is now worth 500 grand. I call you and say, hey, Chad, like, what's happening? And let's say you're honest and you're like, listen, man, it's not doing so well. Like, the market moved, NOI is not like sitting where it should be. If we sell right now, I think I can only return half of your money. Which, just to be clear, this conversation and the transparency of the conversation is, I would say, better than 75% of GPLP communications. Okay? That level of transparency is very rare, and I did not say anything that was like crazy, right? Now here's where it gets interesting, Chad. So what do you think? So you're like, okay, like, thanks. Let me think on it. Let me think what we want to do. And then we get off the phone. So without bringing you as a person in here, like, what do you think an average GP thinks about when they get off that conversation?
I'm guessing they're trying to figure out a way just to get out of that deal and move on to the next. Seems like what majority of theirs is, but they're focused on their own internal needs, if you will.
Okay, so let's assume that's true. In other words, they are out of the promote, so to speak. Like, there's not much money to be made here. Can you see sort of a path to where selling this deal actually gets their business in trouble, even if that's what the LPs want?
Sure, absolutely.
Right,
so it's a credibility story. If your credibility is going to take a hit because you're losing half your money in this deal, that's
there it
get
is.
Around, that'll be an issue for you. Yeah,
there it is, exactly.
Definitely.
And so what's happening now, I can tell you, is this exact thing. Like, LPs are, so to speak, desperate to get their money out. And many of them are like, I don't care if it's like 75% loss, 50% loss, just give me something, just fire sell this thing.
Yeah.
And then GP, on the other hand, again, I'm not talking about ethics here, which certainly have a lot of value, and hopefully GPs rule with ethics. But at least it's hard to discount the fact that at least a portion of their decision is what implications are there to my business if I sell this property at a loss? Like, what happens if I'm going to be on the front of the Wall Street Journal next week as the example of the GP that took LP's capital and sold it at a loss? Now, the counter to that is like, yeah, but the LPs told you to do it, right? Like, yeah, but it doesn't matter. Like, you still did not make a good investment, right?
Yeah, the headlines wouldn't say that piece of it.
Exactly. And so that's where it gets very complicated, Chad. Like, you'll have people that will sort of like, I don't know how else to say it, but they'll ignore LP requests to liquidate the investment because they don't want to take a PR hit to their business. And when you have this like conflict of interest between a GP and an LP, I mean, again, like I said earlier, I think someone needs to hold them accountable. Otherwise, they just don't have an incentive, so to speak, to act. They would rather just sort of kick the can down the road as far as they can so that they don't have to deal with selling something at a loss. And maybe they even issue capital calls, which is a whole other topic. But maybe they even issue capital calls to get more money from you, even though they don't really believe in the investment. But it allows them to kick the can down the road. Like that's a whole other sort of ethical can of worms. But it gets pretty complicated.
Well, and even we've seen the ones that have kicked the can and then had to come back for a second capital call. And then how much are you putting good money after bad at that point that you need to as an LP, be able to stand up and say, no, we don't want to do any more money into this. It's not going anywhere. We don't like your business plan, whatever the case may be. So interesting. Great discussion. Good information. Love your feedback. Love your very thoughtful answers to all this stuff. I think it's great, Alec. It's been really nice to talk to you. Last question we always ask is, what's a great podcast that you listen to that we can share with the listeners as well?
I like to learn from other investors. Personally, there's a podcast called, I think it's Acquired. Let me just check 1 second. Acquired. And I find it to be really interesting. They'll essentially they'll interview a bunch of different famous investors and ask them about their investment process. I think another one that I've gotten really into is Founders, which is really fascinating too. It's sort of like almost like a biography style podcast on a bunch of like fascinating people.
Yeah, no, that's a good one. I would agree. Good stuff. We'll throw those in the show notes as well as your page so people can go out and find the articles that you've written. I think there's a lot of good information in there. Last thing I'll ask you is, how can listeners reach out and get in touch with you?
So I post several times a day, usually on Twitter and LinkedIn. So you can just find that using my name, which is pretty unique. And then I write weekly to 3,500 LPs at lplessons.substack.com, which is also pretty easy to find. Thank you so much for having me on.
Very good. We'll look for that. No, thank you. This was a great conversation. We appreciate you joining the show, and hopefully we'll catch you at BC here in a couple weeks.
Yeah. I'll see you soon.
Left Field Investors is a community dedicated to limited partner investors who are interested in building wealth through real estate investing. The community is focused on education, networking, and engagement with quality operators and partners. We provide tools, webinars, and a forum where members can discuss everything related to real estate investing, including deals, operators, investment strategies, and much more. Coming soon, we're adding a new tool, Sponsor Reviews. This will be a place where our members can rate and review operating partners to further help each other in our investment journeys. Check us out at leftfieldinvestors.com. Investing in syndications can be a daunting task. Wiring a large sum of your hard-earned money to someone you talk to on the phone for 30 minutes can certainly be scary. How can you be confident in what you're doing? Steve Su, one of the founders of LFI, just published a book called Avoiding Rookie Errors as a Left Field Investor. 20 lessons learned from 14 years of investing in private syndications. This is by far the best book I've read on syndication investing. It's an easy-to-read book, chock full of great advice from Steve's experience as a passive investor. It is a must-read. Whether you're a first-time passive investor or a veteran, go to www.leftfieldinvestors.com/books and click on the link to Avoiding Rookie Errors as a Left Field Investor. If you are a passive investor, you got to read this book.
What a good conversation with Alec. A lot of very thoughtful responses to his questions. You could tell he spends a lot of time thinking through this business and has spent a lot of time in the business understanding it. He's a very big picture approach, thinking long term, which I think is very important for the LP side of things. Too often we get caught up in the shiny objects and we, don't really take a look at some of the bigger picture items. I know I'm guilty of it. I think he brings up some really good points that are worth taking into consideration and making sure I'm looking at as I go through my next investments. Loved his, the blunt discussion we had around how LP, we should be as LP investors. Some of us should be in this business, some of us shouldn't. And I love that he says, we should be educated to understand why we are in the industry, so we're not just blindly jumping into these agreements and so forth. I think it's very sound advice to talk about. It's not as passive as we maybe sell it sometimes. We need to be active LP investors as we're looking at things. I also liked his discussion around analyzing pay mix and in the deal structure and understanding that one metric being off maybe is a red flag, not necessarily a deal killer, but should give you pause and make you dig in more. But just the whole philosophy around pay mix and where his logic is, I think holds a lot of water There's different scenarios for different people, different goals that you have set that may cause you to feel differently about that. But I liked his take on the pay mix topic that we get a lot of discussions about. Also liked how we talked about the return on versus return of investment. That's always a biggie to understand. And I didn't pay attention to that early on, but it's very relevant to understanding what money you're getting back as you go through your deal and how that will affect future distributions or risk or whatever. So he had a good discussion on it. And lastly, I thought it was good how he mentioned that his approach or strategy doesn't change because of the economy, which I think is a great point. We should be setting standards for our investments that would hold up under any condition to mitigate our risks. But, understanding what those strategies are is very, very important, but getting them aligned to be de-risked based on the economy, I think is a great idea and takes a lot of discipline, which is a big deal too. And lastly, he talked about how important it is for the LPs to be involved in understanding how a deal is performing, that we should engage with the GPs as we go along, make sure that the GPs manage it the way they modeled in their pro forma and so forth. Again, great discussion there to bring up the point that we can't just let it sit and ignore it and then wait to get money back. We need to stay engaged as these deals move forward and perform, just to be sure we're getting what they said. That way we're educated to know whether we want to reinvest with that operator as well. But also you'll know how your performance is, or your portfolio is going to perform. So great discussion. Really enjoyed that conversation today.
Thanks for hanging out in the left field with us today. If you're interested in becoming a left fielder, you can find us on the World Wide Web at www.leftfieldinvestor.com and click the subscribe button to join our community. If you enjoyed the podcast, please subscribe to the show on your podcast player so you don't miss an episode. If you really enjoyed the show, a review on Apple Podcasts or wherever you listen to podcasts would be appreciated.
This show is for entertainment purposes only. Nothing said on the show should be considered financial advice. Before making any decisions, consult a professional. This show is copyrighted by Passive Investing from Left Field and Left Field Investors. Written permissions must be granted before syndication or rebroadcasting.